What is up, guys? Welcome back. Today we are going to talk about the single most expensive trait in the human personality. It is not ignorance, and it is not fear. It is overconfidence. We all like to think we are smart. We all like to think we are above average. In fact, if you ask a room full of people, are you an above average driver? About 80% of them will raise their hands. Statistically, that is impossible. Half of them have to be below average. But that is the human ego for you. We are wired to overestimate our own abilities. And while that might just result in a fender bender on the highway, in the stock market, it results in financial ruin. Today we are going to dissect the cost of overconfidence. We are going to look at why we think we can beat the market, the data that proves we can't, and how checking your ego at the door can literally make you millions of dollars richer. So if you are ready to get humble and get rich, hit that like button, and let's dive in. The first thing we need to address is the illusion of control. When you are picking stocks, you feel like you are in the driver's seat. You read an article, you look at a chart, you make a decision, and you press buy. It feels like a skill-based activity. It feels like playing chess. But investing, especially over the short term, is much more like roulette than chess. There are infinite variables: interest rates, geopolitical wars, supply chain issues, CEO scandals, that you have zero control over and zero ability to predict. But because you pick the stock, you convince yourself that the outcome is due to your skill. If the stock goes up, you tell yourself, "I am a genius. I saw what no one else saw." This confirms your bias. If the stock goes down, you say, "Oh, it was just bad luck," or "the market is rigged." You take credit for the wins, and you externalize the losses. This creates a dangerous feedback loop where your confidence grows faster than your competence. There is a classic study by Brad Barber and Terence O'Dean titled "Boys Will Be Boys." They analyzed the trading accounts of thousands of households. They found a direct correlation. The more overconfident the investor, the more they traded. And here's the kicker. The more they traded, the worse they performed. The households that traded the most earned an annual return of 11.4%, while the market returned 17.9%. That is a massive gap. Why? Because trading costs money. Every time you buy and sell, you are incurring potential tax liabilities. You might be paying fees, and you are dealing with the bid-ask spread. But more importantly, overconfident traders tend to sell their winners too early to lock in the win for their ego, and they hold their losers too long because they refuse to admit they were wrong. It is the ego protecting itself at the cost of your wallet. Another huge symptom of overconfidence is lack of diversification. If you are absolutely certain that Tesla or Apple or Nvidia is the future, why would you buy anything else? You load the boat. You put 50, 60, maybe 80% of your net worth into one or two positions. You tell yourself that diversification is for people who don't know what they are doing. You quote Warren Buffett about putting all your eggs in one basket and watching that basket. But you forget that you are not Warren Buffett. You don't have access to the board of directors. You don't have 70 years of experience. When you concentrate your portfolio, because you are sure of the outcome, you are exposing yourself to what we call idiosyncratic risk. That is the risk that something specific happens to that one company. A lawsuit, a regulation change, a product failure. If you are diversified, that is a blip on your radar. If you are overconfident and concentrated, that is a catastrophe. It wipes you out. I see this all the time in bull markets. Everyone looks like a genius in a bull market. As the saying goes, don't confuse brains with a bull market. When everything is going up, your bad habits get reinforced. You take risky bets, they pay off, and your brain says, "I am good at this." Then the market turns, the tide goes out, and suddenly, those risky bets collapse. The overconfident investor usually gets destroyed in the first 6 months of a bear market because they refuse to adjust. They think they know better than the market trend. They try to catch falling knives because their ego tells them they can spot the bottom. Now, let's talk about the Dunning-Kruger effect. You have probably heard of this. It is a cognitive bias, where people with low ability at a task overestimate their ability. In investing, this is the person who watches 3 YouTube videos on technical analysis and thinks they can day trade against professional quant funds. They know just enough to be dangerous. They know what a cup and handle pattern is, or what a short squeeze is, but they don't understand the macroeconomic forces at play. They are operating at the peak of Mount Stupid on the Dunning-Kruger chart, and the market loves these people. The market eats these people for breakfast. The professionals, the ones who actually make consistent money, are usually the most humble. They are terrified of being wrong. They are constantly hedging their bets. They are looking for reasons why their thesis might be incorrect. They don't say, this stock will go to 100. They say, there is a probability that, given these conditions, the asset might appreciate. They think in probabilities, not certainties. Overconfidence speaks in absolutes. Wisdom speaks in probabilities. So, how do we fix this? How do we cure our own overconfidence before it bankrupts us? The first step is admitting that you don't know the future. It sounds simple, but say it out loud. I do not know what the stock market will do tomorrow. Once you accept that, your strategy changes. You stop trying to time the market. You stop trying to pick the one winning lottery ticket. You start to respect the market's efficiency. You move towards a strategy of humility. And what does a humble strategy look like? It looks like broad market index funds. It looks like owning the entire haystack instead of trying to find the needle. When you buy the S&P 500 or a total world stock market ETF, you are admitting, I don't know which companies will win, so I will own them all. That is the ultimate act of investing humility, and ironically, it produces superior returns. By stripping away your ego, you strip away the mistakes that come with it. You remove the temptation to overtrade. You remove the temptation to chase hot sectors. You guarantee that you will get the market return, which, historically, has been incredible. The cost of overconfidence is literally the difference between the market return and the underperformance of the average active trader. Over a lifetime, that can be hundreds of thousands, even millions of dollars. That is the price tag on your ego. Is feeling smart worth $1 million to you? I didn't think so. I want you to be the person who is okay with being average in the short term, so you can be wealthy in the long term. I want you to check your ego at the door. Investing is not about proving how smart you are to your friends or to random strangers on the internet. It is about funding your freedom. It is about securing your family's future. And the best way to do that is to get out of your own way. Stop trying to be the hero. Be the methodical, humble, consistent investor who wins by default. If you recognize some of these traits in yourself, and we all do, I battle this myself every day. Drop a comment below and let me know how you keep your ego in check. It is an ongoing battle, and if you want to arm yourself with the right mindset and the right strategies to build real wealth, make sure you subscribe to the channel. We are here to help you navigate this game without losing your shirt. Thanks for watching, guys. Stay humble, stay invested, and I will see you in the next one.